Hello, everyone. Today on the Final Bar, we'll do our normal Friday routine. We will wrap the week. We will focus on these markets, how these markets have evolved over the last 5 trading days. Sort of a renewed sense of optimism from investors as the charts have rotated in many ways and in many individual stocks from a period of correction, a period of pullback to a period of renewed strength. We're seeing stocks like Home Depot and many others sort of revolving and rotating, making new swing highs. Ladies and gentlemen, this is the Final Bar. Hello, everyone. Welcome to the Friday edition of the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a rainy Redmond, Washington. Thanks for joining us every weekday after the close as we focus on the markets and how they are evolving every trading day using the power of stock charts, using data visualization techniques to better quantify investor behavior and investor psychology. I was told many moons ago by many of my early mentors, particularly Ralph Campora, Jeff Weiss, many others. If you know nothing else about the market environment, look at the chart of the S&P 500. Use real simple tools to analyze price, and everything else sort of qualifies that, helps you understand that, gives you context. But at the end of the day, look at a chart of the S&P 500. And when I see the S&P bouncing off swing lows like it appears to have done, when my short-term market trend model reverses back from bearish phase to bullish phase, when you see advanced decline lines rotating higher instead of rotating lower, all those things point to renewed strength. And particularly what's interesting this week, I think, is where the strength is coming from. Some of the cyclical sectors, things like industrials up today, financials outperforming, consumer discretionary at the top of the list. A lot of ground to cover today. I just want to start giving you a preview of what's coming up next week. We had some really good guests this week. I was had a lot of fun talking with Jeff Hughes yesterday. Really great analysis. Clint Cowles as well with a great Elliott Wave take on the S&P. Next week on the 19th, we have Katie Stockton from Fairlead Strategies. On Wednesday, the 20th, Miss Schneider from Market Gauge. On Thursday, the 21st, Craig Johnson, from Piper Sandler in Minneapolis. Then the week after, on the 26th, we have Roman Bogomazov from Wyckoff Analytics in San Francisco. Some other great events coming up. Just as a quick pointer, we had our Chart Madness Revisited special, just aired this morning, actually today, noon Eastern. It was a lot of fun. Go to stockcharts.com/chartmadness for that one. But 2 other events coming up in the next couple of days. Tomorrow, on Saturday the 16th, we are teaming up with Tom Boley at earningsbeats.com to present ChartFest 2021. Go to stockcharts.com/chartfest 2021 for more info on that event. But Tom Boley will be speaking about how he uses stock charts around earnings season. Grayson Rose will be talking about his weekly routine using stock charts chart lists. And I will be presenting how to gather evidence using the stock charts platform. It should be a lot of fun. Kicks off tomorrow morning at 11 a.m. Eastern. Again, go to stockcharts.com/chartfest 2021 for more info on that free event. Next week, I'll be presenting my next free webcast through Market Misbehavior called Buy in October, 5 Charts to Follow. This is a webcast where we actually talk about the seasonal tendencies in September and October, how that actually tends to reverse to seasonal strength in November and December, and how I think you should be positioned to plan between now and year end. That'll be coming up next Tuesday, October 19th, 1 p.m. Eastern. That's a free event, and go to marketmisbehavior.com/October for more info on that free event. Let us continue on and wrap the week. This is our weekly exercise to make sense of these markets using some similar tools. To start with, though, I did want to start with a poll. We asked you recently which sector performs the best between now and year-end 2021. And it's a fascinating poll because I think this is the time traditionally when the markets have been weakening and they should traditionally start to turn higher in the next couple of weeks, strength November and December. What's going to get us there? You said 41% of you energy. Second place was technology with 26%. Far behind those, we had financials and consumer discretionary tied around 16%. Now, I only gave you 4 options, so I limited your choices, but it reminds me of some of the conversations we had yesterday on that Chart Madness special, which was just shown earlier today. We talked about each of those 4 sectors in different ways in some of the stocks that represented. Interesting financials this week where you have a lot of the earnings. And I actually talked about JP Morgan during our special as one of the stocks well positioned. Two of the four experts picked stocks in the technology sector. NVIDIA and Microsoft were two of the ones that were selected, called out as strong potential performance through year end. Energy, though, as you can probably guess, my friend Greg Schnell from GregSchnell.com did a great job of describing the bull case for energy, as he often is able to do. But certainly seeing some renewed strength this week. Stocks like Halliburton bouncing higher, Devon Energy, DVN rotating higher as well. So thanks for answering that poll. There's always a poll running on our live stream page at stockcharts.com/TV and also on all of our social media. So certainly answer those when you can. Let's continue our Wrap the Week segment here, talking about the market. So, I think that this week has really been about the market reverting back to the upside. And the question that I was asked many times, and I think is still an open question in many ways, was that it? Was that the pullback? 6% is it from the September peak to the October low? And now we just rip to the upside. Is that a possibility? Of course it is. And I actually recorded a video last day or two on my YouTube channel called Market Misbehavior, where we focused on what I call the choose your own adventure style outcome, right? Which of these four scenarios is most likely? And one of those scenarios is what appears to be happening so far, which is the bottom's in for October. We rally and make new all-time highs. I don't know if that's necessarily going to happen, but it's certainly one of the scenarios to think about. What would actually cause the market to be that strong from here on out? What would cause an absence of fear that would have to be non-existent to be able to propel stocks that way, right? A lack of selling pressure that would push stocks onward and never upward. If we look today, it was a continued follow-through day on the S&P, which closed around 4470, just above there. Mid caps flat for the day, small caps down for the day. So this was sort of a little different look than what we've had recently, where small caps and mid caps have actually been outperforming here in recent weeks. And if you look at the breadth lines, which hopefully we'll get to in a little bit, the large cap breadth is probably the least attractive out of the four. But overall today, S&P finishing strongest out of those three. The VIX, by the way, continues to go down, back below 20 and now back below 17. It's actually nearing 16 again. Interest rates continue to push higher. So when I see financials outperforming today, I'm not surprised given the strength that we've seen in rates, the weakness that we've seen in bond prices. And upside for yields is certainly potential, or most likely upside for the financial sector. This is basically the business model for your average bank, is the shape of the yield curve. And if you look at 10-year yields, getting above 150, I think was key. 175 is a key level we would talk about. But there's potential upside for there. And, Ari Wald, earlier this week, I don't remember if we talked about interest rates too much on this appearance, but we have talked about it when he's come on the show previously, and certainly talked about the potential for yields to go 2% plus, which is what he's looking for. And I think I would agree that there's further upside to be had for rates. What would that mean for the financial sector and also for growth sectors? What would that mean most likely? Gold, which is sort of our standard inflation hedge, not showing signs of strength today. You had the inflation numbers coming out this week, and gold prices coming back down. Now, this is after a pretty nice bounce overall in gold prices, but the GLD down about 1.5%. Today, finally, cryptocurrencies continuing to push onward and ever upward, with Bitcoin getting back above 60,000 for the first time since first quarter, maybe April. I think it might have teased 60,000 as well. From there, it's been a lot lower, getting down to 30,000. Now we're actually rotating back. It's doubled in the last couple of months, getting above 60,000. And those big round numbers for Bitcoin, 50,000, 40,000, 60,000, have ended up being really, really meaningful. So I would certainly be looking over this weekend if we're able to hold that 60,000 level. I think that's a key line in the sand for Bitcoin. Let's look at our Wrap the Week chart and the official chart, which shows you the returns from last Friday to where we're at today. Let's talk about what the markets have done over the last 5 trading days, and then we'll make as much headway as we can through the Mindful Investor live chart list to finish off this segment. So when we look at the S&P this week, up 1.8%, one of the stronger weeks we've seen from stocks in quite some time. Usually the S&P is not up this much, and we're talking about what got it done outside of large cap stocks, but certainly this week was a strong one. First couple of days actually down, and then you see this rotation higher. And again, I think the question for many investors, myself included, we're back above the 50-day moving average. Do we have enough juice to sustain and hold that 50-day? And I would absolutely be watching that 50-day very closely to see if we're able to hold it. Looks certainly today like we're able to do so. Next week, do we follow through and see further upside there. A couple things underperformed stocks this week. Gold was only up about 0.7%. That's here in yellow. The only thing that really was down for the week was the dollar index. This is using the UUP, which finished the week down 0.3%. Another one actually underperformed. This is small cap stocks up 1.6%, not too far below the S&P's 1.8%. Everything else was outperforming. So in pink, we have the NASDAQ 100 up 2.2%, also emerging markets up 2.2%, and also bond prices up 2.2%, using the TLT as a proxy for bond prices. In brown, we have crude oil, and that was actually the strongest, using the USO, which was up 3%. But if we throw Bitcoin in the mix, you can see why we usually remove it from this visual, because it usually compresses all of the prices in a little bundle there. You can see Bitcoin actually up 13.7%. So as I've told people, if you love speculation and you love volatility, you will find a happy home in Bitcoin. And if you think that's not volatile enough, you've got a lot of altcoins that are even more choppier and more volatile. But, I was asked earlier in an interview today, actually this morning, is Bitcoin, is it really valid? It's such a new asset class. It's kind of had a lot of volatility. Does it really make sense to look at charts? And I reminded the questioner about, my experiences working with currency traders. Early in my career, I would walk on the FX trading desks in the New York area very regularly, and it was all charts. I mean, you had to have charts, and I think you still do if you're trying to trade currencies in the short term, because that is what drives them. They are driven by analysis of charts, because it's all about investor behavior. It's all about sentiment and the short-term fluctuations. I would argue that cryptocurrencies are in very much the same boat. You have limited fundamental data to use to understand them, and so you're left with the crowds and the wisdom or lack of wisdom of the crowds as quantified by the chart. So I absolutely would argue that charts make a lot of sense there. Let us continue on with the Mindful Investor live chart list. To access this live chart list, which I update at least once a week, go to the articles page, go to my page, which is called the Mindful Investor. You will see a link to this chart list at the top of that page, and let's get to it. The first one is our market trend model. This is using weekly data. I've been updating this for years, and it's just a way of oversimplistically quantifying long-term, medium-term, short-term trends. Where is the S&P relative to where it's been? And this attempts to answer that question. We truly have mixed results today, with the long-term model remaining very positive. It's been positive since June of last year. That makes a ton of sense given the strength in stocks over the last 12 to 16 months. The medium-term model for me turned negative in May, and it has remained negative. And overall, again, I don't have a huge problem with that, given that a lot of stocks have really been in a correction for quite some time now. You're now seeing the market in the last 6 weeks register that negative breadth and some of the breadth deterioration and sentiment deterioration. But seeing a bounce again this week, not enough to register a buy signal yet from the medium-term model. This did turn the short-term model back positive. I'll update that here probably after the show to reflect that. It had been negative for the last 4 or 5 weeks, turning back positive, which registers the short-term strength that we've seen in stock. So it's truly a mixed bag. Long-term model bullish, medium-term model bearish, short-term model back to bullish. This is absolutely something I will be watching to determine if and when we get an all clear and indicate further upside potential from stocks. And if you ask me, what would I need to see to turn more constructive? At this point, I would say cautiously optimistic, but still very skeptical of the up move, only given the deterioration that we've seen up until September, and the limited deterioration you saw in the price of the S&P. The S&P is only down 6% from the high in early September to the low in early October. From there, we're now over halfway of the way back up. We're back above the 50-day moving average. We've made a higher low. So on this short-term tactical time frame, I get the argument that we're showing renewed signs of strength. I would need to see a move to a new all-time high, the S&P getting above 4550, and particularly the RSI getting above 60. Neither of those things have happened yet. Getting above the 50-day, that's great. Getting a higher low, that's actually encouraging as well. The breadth picture improving, which we'll look at here in a moment, I think is probably the most encouraging thing, and that's the next chart here. You can maybe see with my very subjectively color-coded lines, these are the 4 advanced decline lines that I keep updated every day. The S&P here is in red. Below that, we have the mid-cap 80 line, the small-cap 80 line, and then the NYSE common stock only 80 lines. That's the broadest universe, but again, it's equal weighted, so it tends to look very similar to the mid and small cap lines, because it's sort of an aggregate of those stocks, to be honest with you. So what do we see here? Well, 3 of these 4, pretty much everything but the S&P, has gone clearly back above its 50-day moving average. Most of these have been below their 50-day moving average since early September. And I think that spoke to the internal weakness in stocks. You can see how most of these have actually rotated back above. The only one that has not is the large cap breadth, right? All the other breadth lines have gotten back up above their 50-day, gotten back above their swing highs from late September, and I think starting to rotate more positively. And that's why I've color coded them back to a neutral color. I'd want to see them get above those early September peaks to consider them to be an all clear, to turn them back to green and indicate a strengthening breadth environment. At this point, I think it's still negative to flat or negative to neutral, bearish to neutral overall and aggregate. The large cap 80 line is something I'll absolutely be watching. Given a bounce, continue to bounce on Monday, I think you could certainly argue for those turning more positive. We're seeing new highs increase over the last couple of weeks. And if you saw in September, you had declining new highs going into September or September into October, increasing new highs. And so again, a healthy bull market phase sees more and more stocks making new 52-week highs. We saw this week Home Depot, some of the financials, others making new 52-week highs. We need to see more and more. And I think what we've seen in the last couple of weeks shows that you're starting to see some strength in terms of stocks making new 52-week highs. We need to take a quick commercial break. We'll be back answering your questions from the Final Bar Mailbag. We'll see you in a minute. Hey everyone, welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. Thanks so much for joining us every weekday after the close as we focus on the market environment using the power of technical analysis, the power of stock charts. A couple quick comments before we get to the Final Bar Mailbag. First off, the way we get the questions for the mailbag are from all of you. Our email is always open. We would love to hear your questions about technical analysis, technical indicators, particular charts, ETFs, ratios that you're struggling with. Send us a chart via email, and we would love to answer your question on the air. Our email address is thefinalbar@stockcharts.com. We are on Twitter @FinalBarSCTV. We're on YouTube on our Stock Charts channel. Just put a comment below the video that you're watching there. We'll gather all those questions. We'll hope to answer one of yours in our next mailbag segment, which will be on Tuesday of next week. Also, as a reminder, go to StockChartsTV.com. That is our on-demand platform. This is a custom designed platform really meant to optimize all the great content that we have presenting for you every day. Every trading day, we have new content coming your way. Great special events like Larry Williams, who just recorded a special broadcast earlier this week. Our follow-up to our Chart Madness special in March, which just aired today, called Chart Madness Revisited. Our year-end special programming in December, our yearly outlook in January, all of that and more at StockChartsTV.com. Also on your mobile device, just search on any of the app stores for Stock Charts TV on demand. Let's continue on with today's show, answering your questions from the Final Bar Mailbag. As a reminder, all these questions have come from viewers like you. We appreciate your questions. Keep them coming. thefinalbar@stockcharts.com is our email address. Question number one. What are the key things that would confirm that this pullback is over in the short term? Believe making a higher high on the SPY above 452 would confirm it, but that would mean leaving a lot of gains on the table. And that's such a really good question. I'm bringing up the daily chart of the S&P. I feel like we talk about this regularly, so I don't want to belabor it too much. But if you listen to the questions that I'm trying to ask our guests, again, we have limited times with our guests on Tuesday, Wednesday, and Thursday, but I always try to lob some question about what would you need to see to change your mind? If you're bearish, what would you need to see to turn bullish? If you're bullish, what would you need to see to turn bearish? I think that's an interesting way to sort of think about how these different experts are considering risk management. And I think your question actually has an interesting point embedded in it. You said, would it take a higher high on the S&P, which is really taking, meaning above the September high, the S&P getting above 4550? That would confirm, and I think you're absolutely right. Your comment was that would leave a lot of gains on the table, and I think that's an acceptable risk, right? I think if you don't buy stocks at 4,300, if you don't buy the S&P at 4,300 and you wait to 4,550, are you leaving 250 S&P points on the table? Absolutely. As a trend follower, I am totally happy doing that, because the problem with buying the stocks market at the S&P 4,300 is you are the risk is the S&P goes down to 40, 50, and then all of a sudden you have a 300-point loss on your portfolio. So I think the point of your question is, do you wait until that? I would say as a trend follower, absolutely. I'm happy, giving up some of those early gains to confirm the fact that the trend is also higher. But also remember, it's not just a binary outcome. I wouldn't think in this sort of environment, am I all in 100% stocks or am I all out in 100% cash? It's a question of layering in and out. And I think, if you think about what vehicles you're using, it's whether, do you take a partial position when we break above the 50-day moving average? I could totally see that. Do I complete the position and go all in above 45.50? That would be a great way to think about it. And then you're not doing either or, right? You're taking a little bit of a more aggressive bet and then taking the confirmational bet or confirming it by taking a 100% position when we break out. Same thing when things start to rotate lower. Do you take half of the position off the table and then take it completely off? Do you have different levels at which you would take partial gains or take partial profits and then complete it? That is the way that I think people that trade effectively really do it. It's not about being all in or all out. Just for the sake of simplicity, we have to limit what we're saying on the air only because there's only so much I can tell you in terms of how you would actually trade it. I have to just talk about the charts and whether they're bullish or bearish. How you actually trade around that, I think, is a little more nuanced. But I think leaving some gains on the table to wait for confirmation, there's a lot of benefit to that because a lot, as I was told, all large losses begin as small losses. If you go all in at the beginning and then the market goes down, then you're really stuck. Because then what do, right? You start to take some of the bets off and start taking a loss. If you take a partial entry at the beginning, then you have the ability to buy a little lower if the market gives a little bit of that back, and you still have something to get in with. I hope that was a roundabout way of answering your question, which is yes, I would wait for a break above 45.50 for me to feel confident about further upside. Next question, do you ever use the volume by price overlay to help show important support and resistance levels? If so, how do you choose the optimum number of price bars to use? It's a really good question. Let's switch to a chart like Home Depot. And I've, to be honest with you, not looked at this yet, but what you can do down here in overlays is do volume by price and you pop it on here. So what volume by price does is it basically shows you where we've spent time in these different ranges. And really the logic of this comes from Pete Steidlmeier. There's a whole set of tools called Market Profile or Market Picture. And if you've not read Pete Steidlmeier's work, absolutely read that. My book that I edited a long time, 14 years ago, 15 years ago now, there's an article or a chapter by Robin Mesh, who talked about market profile and applying it to different environments. And I think there's a lot to be said. It's all about market distribution. The fact that the markets will actually have a bell curve of sorts. They'll sort of fill in a bell curve and then they can rotate out of that direction. And Pete Steidlmeier did a whole set of tools built on and called Market Profile. It's built on that. And volume by price is basically a way to incorporate that idea into prices. To be honest with you, I don't think a ton about it. And you can customize the parameters and customize the ranges that you're using here. For me, is there a way? Does this help you identify support and resistance levels? Absolutely, and I think that's the idea of it, right? When you're looking for where the volume is sort of pooled up, where we've spent a great amount of time, where we've had a lot of transactions. The idea is that is where support and resistance levels should focus, and I think there's a lot to be said for that. I think it really is dependent on the individual charts. When you bring it up for the first time, it sort of does a good guess based on the price range that you're doing it. It tries to make it, you can tweak it a little further if you like. I would do it based on the particular instruments to see what helps you quantify or visualize the support and resistance levels most effectively. Next question. I know many CMTs talk negatively about bottom fishing, but if one were to engage in the act, how would you imagine a skilled CMT applying TA to the effort? Such a great question. And it's funny when you say a lot of CMTs talk negatively about bottom fishing. I'm certainly probably guilty of that, and I don't think it's talking negatively about the practice of bottom fishing, but it really differs from our training and what you think of it. I think the technical toolkit, especially as followed by money managers, and if you're a CMT, you're a financial market professional, meaning you're probably working with professional money managers. You're not trying to bottom fish. You're not trying to buy really weak charts. You're trying to buy things where the trends are more constructive. That is what most institutional technical analysis kind of looks like. It's more growth oriented. It's more trend following, and it's more getting into established trends. Having said that, there are plenty of tools that I think could help you think about bottom fishing, things that I would be looking at. Number one, RSI, looking for stocks that are oversold. Number two, bullish divergences, looking for stocks that are oversold, but are starting to show improvement. Stocks going lower, but on momentum that's actually dissipating. So lower prices, higher RSI. That's probably one of the most important things I would look for. And also things like MACD or PPO. Those are really meant to be mean reverting tools, meaning you're buying weakness and selling strength. So stocks where the MACD or the PPO has gone down quite a bit, starting to rotate higher. So buy signals from MACD. So a general screen I would be looking for, and I'm just totally making this up, just thinking about what I would look for because I don't run these regularly because I'm not trying to bottom fish, but I would say things, an RSI below 40, buy signal from MACD in the last couple of days. That would be a really good starting point for stocks that I think could arguably be looking at bottom fishing. And bottom fishing in general just means you're buying weaker charts rather than stronger charts. The other thing I would look for is stocks that have had a move down to key support levels using Fibonacci retracements, other things like that. A lot of the banks, stocks that have had bounces and rotating higher came off of key support levels. So look when that lines up to the indicators I mentioned earlier. That's how I would answer that question. Those are really good questions. We have more to get to, which we will get to on Tuesday. Keep them coming. The Final Bar at StockCharts.com is our email, but we need to wrap this show. Go to the 3 and 3 charts in 3 minutes. Here we go. Chart number one is a ratio that I love to follow. This is an offense versus defense ratio, looking at the XLY and the XLP. And this really was inspired for me. This became a part of my process when I talked with Bill Doan, who sadly is passed away a number of years ago, but he was one of my predecessors running the technical research team at Fidelity back in the 1970s. And I had a lot of fun talking with him about how he approached the markets. And they had a chart in the Fidelity chart room that was a different set of indexes, but was basically, this was the essence of it. And I think it's a good modern version of what they did. It was trying to understand when institutions were rotating to the offensive side or the defensive side of the consumer space. So consumer discretionary versus consumer staples. Now we have ETFs that track the equal weighted version of that. And I think that's a really good ratio to follow. It's the RCD versus the RHS. If you look this week, both of those ratios are making new highs, and especially the equal weighted version, I think, is most important. So it's not just Amazon, which is looking pretty constructive. It's not just Home Depot, which is making a new 52-week high today, I believe. It's also the equal weighted version. It's sort of the average consumer discretionary versus consumer staples. When the market really is something to worry about, when investors are really getting defensive, this ratio should be going lower in a big way. It's really not. So even though the S&P is not making new highs, it tells you that investors are still positioned for the market doing so. And I think that's an important bullish tell to keep in mind. Chart number two is the GBTC. Now, Bitcoin is a tough one for a lot of people to actually gain exposure to, because if you're an individual investor and you want to go and create, get a Coinbase account or have some digital wallet where you can park your coins, that's great. But a lot of institutions, a lot of financial advisors can't do anything like that. And so I think it's still very underappreciated as an asset class because it's just not as accessible. And we have Bitcoin futures, that's great. We have Bitcoin ETFs, which are starting to potentially form. You're limited still in terms of the exposure you can have. The GBTC is the way I've seen a lot of people do it. The problem here is it trades at times at a very big premium to its net asset value and a big discount to its net asset value. Still trading at a discount. Last time I checked, it was like 15 to 20% below the net asset value. And I think so. While buying something like the GBTC gives you exposure to the upside in Bitcoin, it also gives you exposure to the fact that if we go back to a premium, which we're not at yet, that presents some potential upside as well. From a technical perspective, getting above an ascending triangle pattern, breaking to the upside, clears the way to the all-time highs from February and March. Finally, the financial sector, the XLF, making a new 52-week high today. In our Chart Madness Revisited special, we each had to pick one of those 16 stocks that we thought gave the best prospects between now and year end. I actually picked JP Morgan. I got some giggles from others in the group that picked technology and other spaces, but I went with JP Morgan because I feel like rates have higher to go. I feel like stocks, and again, we didn't have a lot of financials to choose from. It was that or Travelers, I think, were our two, but I went with JPM, and I think the XLF going higher this week, driven by the strength in earnings, I think tells you about the upside prospects. This is definitely an interest rate play. It's suggesting interest rates go higher. The XLF is making new highs, which tells me that there could be further legs in that sort of move. Folks, that is our show and a wrap for this week on the Final Bar. I want to especially thank all of you for watching our show every day. Our guests have been fantastic. If you missed any of our previous episodes, some of these really important interviews, I'd encourage you to go to our on-demand platform, stockchartstv.com. They're all there. They're time-stamped. They're date-stamped. A lot to be gained there. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a great weekend. We'll see you on Monday.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.